And joining us right now on Money FM 89.3, Steve Brice with us, who is the Chief Investment Strategist of Standard Chartered Bank. Steve, thank you for being with us.
Thank you so much.
First question for you is, how do you see global growth panning out in the second half of this year compared to the first?
Yeah, obviously we saw a big pickup in the US economy in the first half of this year. I think what we've seen, we saw convergence last year of economies, saw divergence in the first half of this year. I think over the next 6 to 12 months, and I wouldn't like necessarily it's going to be in the next quarter, but over the next 6 to 12 months, we probably see that growth reconverging. So Europe probably recovering from the disappointments of the first half and doing slightly better. And on the other side, the US really failing to keep delivering upside surprises to the growth environment. So holding up reasonably well, but not setting the world on fire.
All right, well, you've mentioned Europe, you've mentioned the US, but closer to home, there could be a trade war happening with China right in the middle, and then headwinds, of course, faced by the emerging markets as a result of that, potential slowdown in China. Any comments on that?
I think it's almost a policy to accept a slowdown in China. So from that perspective, that's what we should expect. Clearly, as the economy gets a lot bigger, it's harder to keep growing at 8-9%, and we've obviously seen that in the data with the slowdown coming. So we expect that a long-term trend to play out. We're not expecting a hard landing. I think obviously we're in the eye of the storm as far as trade tensions are concerned. Our view there is that China's actually willing to strike a deal. The US probably needs to decide what it really wants and communicate that in a consistent manner, rather than through presidential tweets all the time, maybe actually talk at the negotiating table. And remember, Trump himself is actually a deal maker. So what he's, in my view, been doing is he's been sort of creating problems, but then solving them. And I think the North Korea situation was a great example of that. I think the trade tensions, at least on a 6-month basis, are probably likely to go a little bit into the background once we get closer to the midterm elections.
So as a strategist, it doesn't sound like President Trump's the one that keeps you awake at night. What keeps you awake at night?
Well, I mean, the trade tensions is something that, look, we could be wrong, right? And that's a deal breaker from a global growth perspective. If we do go into full-blown retaliatory trade war, that's really challenging. Our view is that won't happen, but it's a big thing. The other thing then is the end of the cycle. So normally economic cycles come to an end when inflationary pressures pick up, central banks put their foot on the brakes, and that leads to slower growth and eventually a recession.
Okay.
That we're getting closer to the end of the cycle. We think we've got 18 months left, but that's what we're really looking out for.
All right. And then when it comes to the next 6 months, what are you advising your clients when it comes to protecting and growing their portfolios?
So our favorite asset class remains equities. So, and that's tied to this economic cycle view that we still have 18 months left of it. So equity markets usually peak 6 to 9 months before a recession. So if we've got 18 months, we've still got some money to make in equities. And it's not picking dimes up in front of the wheelbarrow or whatever, steamroller. Usually that last 6 to 12 months can generate 15-20% returns. So it's actually quite important to still be invested. Over time, we think as bond yields go higher, we would be looking to add bonds into our portfolio. In fact, that's what we've been doing into our recommended portfolios, to sort of say, look, take advantage of these higher yields and also prepare for the ultimate downturn in the economy, which is going to happen. It's just a matter of when.
All right. When it comes to asset classes that you're most cautious about, which ones would they be?
I think, at the moment, gold's really been an underperformer. So that's an area that we're still pretty concerned about. In the short term, we've got emerging market assets are going through this trade volatility, but actually we see that as an opportunity to pick up assets rather than be excessively concerned now.
All right, thank you very much for your outlook.
Thank you, it's very kind.
Steve Brice, Chief Investment Strategist at Standard Chartered Bank, speaking with us here on Money FM 89.3.
Money FM 89.3